Let's just go through another example of a KISS, ready, aim, fire, this being the aim. The ready is your bullish, the aim is location, and what's the fire? Well, we're going to show you a couple. Green laser, which is bearish, but when it goes green to red, that's bullish. When you breach a pink, that's bullish. When you get a blue, that's bullish. And you're going to get one of each. You're going to get a blue right there. You're going to get red right here on the laser, and you breach the pink. That's the KISS into the PWAPs, the ready aim, and then this becomes the fire. Then we fast forward and you start to create right here. If you look at the top, and this is just should be reading charts 101, but it's not for most people. When you see several tops like this, it should be easy to assume, and it becomes a pretty accurate assumption, that above here, people who are short are going to get nervous. They're going to start biting their fingernails. They're going to put buy stops up here. They're already laying buy stops up there to cover their shorts. And if you ask most people, hey, if you're short in this market, where do you think you're wrong? Most people are going to look at this chart, then read it properly and say, well, probably above there. Well, if you say that, and you say it pretty quickly, you could rest assured most people who are short are going to say that and do that. So a call of be careful being short above this yellow line because there's the beginning of buy stops coming out is not and should not be random or controversial, nor should you be surprised. And you see me put the yellow line there on recording, nor should it be a surprise when you do this and you walk right through it. And then you get the follow through, leaving this range, so to speak. So most people could identify a range if you ask them to, but then what do you do with it? And just put yourself in a position, if you were short, where would you be nervous? And if there's a quick, easy answer of where you would be nervous, then it's safe to assume so would the market. And what we're trying to read is where are these future buyers and sellers going to come in and why? And as we know, and you see this time and time again, that shorts are future buyers and sellers. And if you have trouble understanding that, what order do you use to cover your short position? A buy order or sell order? You're already short. What order do you use to cover that short? Use buy orders, period. Be a buy market to quickly get you out. Could be a buy limit below because you think price is going lower. I hope you think price is going lower if you're short. And buy stop above to manage your risk. Either way, you are a future buyer. That's ultimately what we're doing, trying to predict future buyers and future sellers and then compare them to each other to give us a better idea and probability as to where price is going because price needs this. It needs more future buyers than future sellers. When you get more future buyers than future sellers, you should be bullish. You should think price is going to rally because this is not only kind of important for the price of something to rally, it's imperative. I just remember this call from a long time ago explaining something like this to someone, and they go, oh, yeah, that would be helpful if you had more, future buyers and future sellers for price to go up. I said, helpful? No, it's necessary. It's imperative. You can't go without it. And then they got it. I got through to them. It's not helpful. It's necessary. And so, how do you predict? Not buying and selling, because that's not predicting. A lot of charts and platforms show you buying and selling. There's nothing that's really predictive in talking about buyers and sellers that are trading right now or traded 2 minutes ago. Everybody sees that. You have to be able to predict with some semblance of probability of what's going to happen. And you're going to have to say, well, we're going to need more buyers and sellers in the future. Where are they going to come from? Well, guess what? More shorts than longs give you this. That gives you more future buyers than future sellers. The other thing I'll leave you with is you you have to remember just knowing future buyers isn't enough because let's just use 100 for an example. All right, just for example's sake. The number 100 could be a really, really big number if the number you're comparing it to is 5. Then 100's a lot. But it's not a lot if you're comparing it to a number that's 100. Then it's not a lot, right? Compare contrast is going to be where you find the value of something. So just looking at a raw number isn't going to give you the answer of whether or not it's big or a lot. When you're able to compare it to something, now you get to a point in your predictive skills to say whether or not it's a big number. Because sometimes it is, sometimes it's not. You cannot just look at it um, on its face and say, oh, that's a lot. Not always. So compare contrast is the way we value everything. And people get into this business and they're like, yeah, you know what? It makes sense that I would compare A to B because I do it when I try to predict the price of anything, a plane ticket, a car, a house. Everybody, when they try to find a good price on airfare, what do? All the platforms out there and websites out, they do it for you. They compare all the airliners to where you're going and when you're going, and it gives you all the prices. And you could say, hey, airfare is good and this one's cheap. How do you know it's cheap? Because it's a lot less than the other three airliners. But compare contrast is what we use our whole life when we buy and sell things. And yet, when people get into this business, they tend to ignore those techniques.